What if I told you there's a way to invest in the stock market without timing it, without watching charts all day, and without needing a huge amount of money up front? In fact, this strategy is so powerful that it turns market crashes into opportunities and removes emotion from investing completely. Stay with me, because in the next 5 minutes, I'm going to show you how SIP can automate your path to wealth. Welcome back to the channel. And if you're new here, we talk about real wealth-building strategies that actually work. No hype, just facts and actionable advice. Today, we're diving deep into SIP, Systematic Investment Plan. Now, if you've heard this term before and thought it was boring or complicated, I'm about to change your mind. Because SIP isn't just an investment strategy, it's a wealth-building machine that works while you sleep, while you work, and even during market crashes. And here's the best part. You can use SIP to invest in mutual funds, ETFs, and even individual stocks. By the end of this video, you'll know exactly how to set up your own SIP and start building serious wealth on autopilot. Let me ask you something. Have you ever tried to time the stock market? Buy low, sell high, right? Well, here's the truth. Even professional fund managers fail at this 80% of the time. So, what if I told you there's a way to completely ignore market timing and still build massive wealth? That's exactly what SIP does. SIP stands for Systematic Investment Plan. It's simple. You invest a fixed amount of money at regular intervals, weekly, monthly, quarterly, into your chosen investment, whether that's a mutual fund, an ETF, or even stocks. Instead of trying to predict whether the market will go up or down, you just invest consistently, month after month, year after year. And here's where the magic happens. When the market is high, you buy fewer units. When the market crashes, you buy more units at a discount. This is called rupee cost averaging, and it's one of the most powerful wealth-building concepts in finance. Think of it like filling a bucket with water. You don't wait for the perfect moment to pour water in. You just keep adding a little bit every day, and eventually, the bucket is full. SIP works the same way with your wealth. Let's start with the most common use of SIP, mutual funds. This is where most people begin their investment journey, and for good reason. Here's how it works. Let's say you decide to invest 5,000 rupees every month in a diversified equity mutual fund. You set it up once, and every month on the same date, 5,000 rupees automatically gets invested from your bank account into the fund. You don't have to think about it. You don't have to check the market. It just happens. Now, let's look at a real example. Imagine you started a SIP of 5,000 rupees per month in a Nifty 50 index fund 10 years ago in 2015. Your total investment over 10 years would be 6 lakh rupees. But here's the kicker. That 6 lakh rupees would be worth approximately 12 to 14 lakh today, depending on the fund. That's more than doubling your money, and you didn't have to do anything except set it up once. This is the difference between people who build wealth and people who just dream about it. One group automates their investments. The other group waits for the perfect time that never comes. Mutual funds are perfect for SIP because they're professionally managed, diversified across multiple stocks, and you can start with as little as 500 rupees per month. You get instant diversification without having to research individual companies. It's the easiest way to get started with SIP. Now, let's talk about ETFs, exchange-traded funds. ETFs are like mutual funds, but they trade on the stock exchange just like stocks. And yes, you can absolutely do SIP in ETFs. Here's the difference. With mutual funds, your SIP is automated through the fund house. With ETFs, you need to manually buy units every month through your brokerage account. But here's why it's worth it. ETFs typically have lower expense ratios than mutual funds. We're talking 0.05% to 0.5% compared to 1% to 2% for mutual funds. That might sound like a small difference, but over 20 years, that extra 1% fee can cost you lakhs of rupees.